Thanks so much, Eka, for the wonderful presentation on how to play Make a Move and a little bit about the research and development that goes into the game. My name is Emily Roberts, and I would like to do a financial analysis of Make a Move. So, without further ado, let's take a look. So, I'd like to compare Make a Move to similar companies such as Hasbro and Mattel. Attached, you will see the Mattel financial statement and the Hasbro financial statement. We know the market is expanding, and so are we. As Kevin said, our long-term goals is to kind of create a domino effect with this game, meaning it would expand the Parker Brothers games. People go to buy Make a Move, they love the game, so then they go and buy more Parker Brothers games. We also would like to maintain customer interest and be the go-to game. So if all goes according to plan, these would be some of the figures that we are expecting to see. So to start off, I would like to analyze profit margins of Hasbro and Mattel, and then base these compared to the Make a Move and the St. Vincent Games as an overall company. The profit margin, to begin, is a measure of profitability. Basically, it's the percentage of the selling price that's turned into profit. To calculate the profit margin, you simply divide net profit by revenue. So in 2013, Hasbro had a profit margin of 7.64%, and Mattel had a profit margin in 2013 of 10.07%. So just based on these numbers, we are expecting a profit margin of 9.85% in our beginning year. This is a wonderful profit margin to have, meaning you'll make roughly 9.85% of profit based on just your selling price. Next, I'd like to analyze the return on investment. Now, the return on investment evaluates the efficiency of an investment. To calculate the return on investment, on the top as the numerator, you do gain investment minus the cost of the investment, and you divide that all by the cost of the investment, and that will give you your ROI percentage. So Hasbro had a return on investment percentage of 23.88% in 2013. Mattel has 27.70% in 2013, which leaves us with an expected 29.85%. Now, ours is a little bit higher than these two as we have very low costs of production, and we are expecting an extremely high selling rate for this game. So that is how we get the higher percentage of return on investment, as some Hasbro and Mattel games cost a little more to produce, but we have such low production costs that leaves us with such a high return on investment. Now, our net sales are a little bit interesting, as we see Mattel and Hasbro differing slightly, well, not slightly, 2 billion is not slightly, but so 2013, well, your net sales, first of all, is the amount of sales generated after all deductions have been counted for. So deductions would be such as a loss of good, lost or damaged merchandise, or defective merchandise. So after all these deductions have been made, these are the sales that we will see. Okay, so in 2013, Hasbro had 4.08 billion in sales, in net sales. In 2012, they had 4.09 billion in net sales. Mattel had 6.48 billion in sales in 2013. In 2012, they had 6.42 billion. So we roughly lie somewhere between Mattel and Hasbro, I would say. So our expected sales would be 5.42 billion in our starting year. Next is gross income. Gross income is a composition of revenue minus cost of goods sold. So Hasbro in 2013 had 1.99 billion in gross income. In 2012, 2.01 billion. Mattel 2013, 3.47 billion. 2012, 3.40 billion. Now, once again, we are a little higher expected income than both of these because of our low production price. I would expect us to come in at around 3.8 billion, if not more, in our starting year. Stock prices. Stock prices are give you a very good look at exactly how the companies are doing and exactly where they are lying in their profitability. So Hasbro in 2013 came in at a low of $35 per share and a high of $44.14 per share. Mattel actually has a chart comparing it to common stocks, SAP, SAP 500, those stock prices, and they are also growing exponentially. So this leaves me at the assumption of $40.07 per share of stock for St. Vincent Games, specifically Make a Move game. Dividends. Dividends are the payments that go back to the stockholders after all profits have been accounted for. So that dividends also, along with stock prices, give you a very honest clue as to how exactly the company is doing, where they are coming in at, how much they are making, if they're going to last, etc., etc. Hasbro had $1.60 per share, so meaning you pay $100 per share, you'll make $1.60 on that per share, or whatever you pay, you have to calculate the percentage. Whatever you pay on that, you're going to make $1.60 out of that. Mattel had $1.44 per share, so I would say our expected would be 1.32 per share, if not more, meaning $1.32 per share. Assets. Assets are anything that the company owns, whether it be merchandise, inventory, cash, etc., property, real estate, any equipment to make the games, anything like that can be considered an asset. In 2013, Hasbro had 4.4 billion in assets. In 2012, 4.32 billion. Mattel 6.43 and 6.52. I expect our assets to lie somewhere in between at 5.31 billion in assets. Cash specifically is very important because it shows just how much profit is being made and where the cash flows is coming from, who we owe money to, how much we have sitting in the bank, etc. Hasbro 682.4 million, 849.7 million. Mattel 1.039 billion, 1.335 billion. I expect us to sit somewhere in between 900 million and 1.56 billion in our first year. Liabilities and inventories also can be considered an asset and also a liability. Inventories can be a liability as they are sitting there unsold stock or unsold merchandise. Also can be an asset because they're being sold, bringing in profits, bringing in revenue. Hasbro has 348.8 million in 2013 in inventory, and Mattel has 568.8 mil sitting in inventory. I expect us to be very different from these prices as we have such a high sales rate and such a low production cost. So this will leave us roughly at 275.2 million. So overall, our company is wonderful, a wonderful idea to invest in as we have such a low production cost, such high profit margins, such high return on investments, and such low liability in our company. So thank you so much for taking the time to listen to our presentations. We hope you're satisfied with our predictions and our strategies, and we look forward to speaking soon. Thanks so much.